Thank you. Yes, Asia is definitely a part of the world I love going to. Ever since 2000, I've spent between 3 and 6 times a year in various countries in Asia. We tend to say Asia, Asian markets, but there are so many different countries and so many different cultures. So many different markets and aspects to those markets, not only in the businesses and how they are, but also in the investments that can be done. Because if we speak different markets and different cultures, there are also different tax regimes, different political systems, different religions, different everything. So I'm really privileged here to have in the panel many people who know a lot about Asia and who work with Asia or who live in Asia. And it is really a great pleasure. I think that this panel also is a great, wonderful, timely topic with Xi Jinping visiting Europe at the moment and promoting the Belt and Road project, and a very controversial seen from the European side or the European Union side, though if you look at Asia and the impact on Asia, it's a more favorable view of that. Really, Asia in terms of investment, in terms of working with families, family offices, great opportunities to be there. So many different opportunities. I see with pleasure a lot of next generations of family businesses venturing into Asia to develop new businesses, new investment, new strategies, and to spend part of their lives there, really enjoying first of all, the freedom to be away from their family and too much control from the previous generations, but also being able to discover new markets and to have phenomenal growth and to be able to build on that phenomenal growth of Asia. To start talking about Asia and to give a more rounded approach and a more diversified approach of Asia, I would like to ask Claudia Zeisberger to come and present. Claudia has, for those who were not here this morning, is a professor at INSEAD. She spent past 14 years, she was in the banking and investment industry before and spent the past 14 years teaching at INSEAD. On that very topic of private equity, but family offices and wealth and investment. So please come.
Thank you. I can hold this. Okay, so good afternoon. Anyone who wasn't here this morning, don't worry. I'll snuck a few more slides in that to kind of just remind us all, because I know how it goes. I show you something once, you kind of remember it. The second time, it sticks a lot more. So yes, thank you for the invitation. I just have I will not take 10 minutes just to set the scene and give you some food for thought. Private equity, Asia. So I've been in Asia since 1995. I went there for 6 months and I never came back. There was a reason for that. It was by choice. And the reason was it was very exciting. It was much more exciting than the US and Europe at the time. And I'm a firm believer that it will remain exciting on many levels for time to come, and exciting in a good way. So just very briefly, remember I showed you this morning global numbers. So this is Asia, basically assets under management for private equity. So I've been asked to focus on PE only, and will do so. Again, it has grown, not quite as fast by our measures as globally, but very much held pace with the rest of the world when it comes to private equity. Remember, we talked about this morning, how Asia is quite different from the rest of the world. So, for example, when I have family offices come to me, European ones, and say, oh, we're now getting serious about Asia. Yes, we've always had a global mandate, but de facto, what we've done, we've focused on Europe and the US. We never really done Asia seriously. I now want to do Asia seriously. So, as you know, in private equity, diversification in private equity is tricky. So you're diversifying not just venture growth buyout, and I'm keeping it simple here, I can make it much more complicated. You're also diversifying regionally. So if you're saying Asia, as you rightly said, there's no such thing as Asia. So you need to allocate then basically China, India, and even Southeast Asia. Right, and then yes, North Asia, there's still Korea and Japan, which shouldn't be ignored. Japan is getting kind of like a revival again in terms of private equity. All of a sudden, people seem to have forgotten for 15 years that there was Japan. Now this is changing. So it's complicated. And then you're obviously diversifying as well across vintages. So it's not just that you're saying, okay, I'm going to allocate to private equity or growth equity in Asia. You'd want to basically backfill your vintage as well. Secondary markets in Asia are still in their kind of infancy, so kind of backfilling your portfolio is complicated. I just worked with a small European pension plan recently, and together with the partners group to develop a portfolio that kind of reflected what they thought Asia should look like in the portfolio. So it's not easy. In terms of depth as well, you have fewer funds to allocate to. Most funds have a shorter history than European and American funds. So again, if you're going the fund route, it's depending what your minimum requirement is in terms of how many fund lives do you need to see before you get comfortable in it. I hear very often that LPs don't want to do first-time funds. Nevertheless, I find family offices are much more willing to actually take that. And given that from an academic point of view, we've seen first-time funds outperform existing funds. So finding the right ones, that's an interesting approach to take as well. So keeping that in mind. We talked about valuations. Valuations in Asia are steep. Okay, they are not cheap. Getting into Asia now, if you haven't already invested and you're just adding on to your portfolio, expanding your portfolio, takes, I mean, if you're coming with your European lens or your North American lens, you basically need to realize what is going on there and to get comfortable with it. We're seeing a lot more regional funds now. We're seeing a lot more specialist funds emerging now. So for example, healthcare only. 8 years ago, you would have not found that. There were generic funds. Pan-Asia versus country-specific funds, we can have a long conversations around that. There's no right or wrong answer, right? Ultimately, and I'm so far only touching on the fund route of investing. If you're thinking of investing basically direct in investable companies in Asia, it pretty much requires local teams on the ground. Those funds that have basically local teams on the ground tend to outperform those that don't. So in general, I'd like to compare it to Europe. Asia is much more diverse in terms of culture, behavior, deal making than Europe is. So you're having a higher likelihood of sending a French person to doing deals in Germany or in Poland than sending an Indian person doing a deal in China. So just to put that in perspective, it's very, very different in terms of culture. Family offices, I showed you that before. So wealth generation is basically huge in Asia, which also means for you as an investor coming into Asia, there's plenty of competition. Plenty of competition. It's not like that Asia is waiting for more money coming in. It is not. So you got to be aware of that. You're competing against local family offices or against local investors as well. That potentially may be seen as having an advantage over being a non-Asian entity coming in. This is basically just slicing it in different ways. So wealth growth, it doesn't matter how I slice and dice it, Asia always basically wins out in terms of the growth of wealth. I'll come to the next generation in a second. So just to give you an idea when it comes to private equity as well, nevertheless, the generational handovers that we may expect to see in Asia will offer opportunities for private equity as well. And a lot of the private equity funds are basically waiting for that to happen. I mentioned earlier on this morning that it's difficult to do majority deals in Asia because the families are kind of like reluctant because we're in the first, second, maybe third generation to give up majority in the companies. That's changing with the new generation. Okay, and that gets the private equity houses quite excited. They may finally get their hands on majority stakes in assets that are really quite attractive. So in terms of deal flow, the younger generation being more willing to let go of some of the family assets may actually be quite attractive. Now, US, Europe, about 50% of all companies are family businesses. In Asia, that's a lot more. Okay, so across Southeast Asia, it's about 85% of $1 billion+ businesses are family run. If I then basically put Indonesia on top of it, 95% of all businesses are family run in Indonesia. So now that basically puts a complete different lens all of a sudden onto Asia in terms of deal flow, because private equity very much depends on deal flow. I may be raising a great fund. If I can't find investable assets, what's the point, right? We basically, as I said earlier this morning as well, we expect that in the next 5 years, just under 40% of family businesses in Southeast Asia will go through a generational handover. What does it mean? Two things. Normally at that inflection point, you have A, family wealth being carved out, and B, assets changing hands. That means there will be assets coming up. Maybe your great-grandfather's first manufacturing plant in Indonesia will be on the block. So we expect more assets to basically, investable assets to hit the private equity stream. Not always is the next generation able or willing to step into the shoes of their elders, if you like. I'm at the receiving end of quite a few of MBAs that basically come to me and say, well, my family has this very profitable business in the middle of China. I don't want to go back there. Can you find me a private equity buyer that wants to buy that? So to which I normally say, have you spoken to your father? And the answer normally is not. So I said, that's step number one. And that's not in my remit. I'll send you to one of my colleagues then to talk to. But so as you see, there are opportunities, and it will remain exciting from a private equity point of view in terms of assets coming out. But also, I mean, it will come with challenges. And I can't remember who said it this morning. I think Marius mentioned it, that a very small portion of families and family businesses make it to the third generation or through the third generation. Just keep in mind, in Asia right now, we are at that third generation. So whether that third generation makes it or not will have a tremendous impact. Forget about it, the businesses, just as Asia as a whole as an economy. So if on average we basically live up to that statistical number, it will be a critical point for Asia in general, all right? And that's it on my side.
Thank you. Thank you very much. The next, I would like to have Amber come here, also because I think it is also important to have the Chinese perspective, but Amber, or Aiping Gao, lives in Hong Kong, comes from Hong Kong. She studied both at the, please come on stage, at the China University. She studied politics and law. Interesting combination of topics. And also at the University of Essex. And she's a member of the China M&A Association. She's currently setting up business that is screening investment opportunities. And she has quite an interesting take into very new tech elements and AI and investment in those. So Amber, please.
I need help. It doesn't move.
Huh?
So
it doesn't work?
It doesn't work. Yeah.
Does it work here?
No.
It doesn't work anywhere, not on the computer either. Shall we?
Hast du nicht umgeschaltet? Entschuldigung? Are you sure? It's good. Okay.
Perfect. Thank you.
Sorry.
So let's see. Well, thank you very much. It's my pleasure to be here to present this topic. Yesterday, I was told that I have 15 to 20 minutes for this presentation. But at lunchtime, I was told I have only 10 minutes, which means I will have to drop off 50% of my presentation. So after this presentation, if you have any questions, please just ask me in the Q&A section. Thank you. So let's take a look of the new opportunities for investment and the technological innovation and development in China. It's quite an interesting topic. So By evaluation of the technology, market size, and the ecosystem, there are 6 industries are very potential in the next 5 years. So today, we are going to focus on the first 3 industries: AI, smart manufacturing, and TMT, IoT, and 5G, because those 3 industries are closely combined and promote each other. So let's take a look first of the AI, which is perhaps everybody interested. So the development of AI depends on 3 core elements: data, algorithm, and also computing power. So in the industry segment, AI combined with medical, automatic driving, voice interaction, AI chips present a new format, which is in its second phase with a focus on application. AI must be applied to the specific application scenarios truly serving the current industry. At the present, some directions can be implemented in the agriculture, medical, logistics, finance, home, education, industry robots, VR and AR are the fastest growing. So there is a specific and unique advantage in China I would like to point out is the huge amount of data. The machine learning technology behind the current AI boom is extremely dependent on data, recognizing faces, translating languages, and experimenting with self-driving cars that requires a huge amount of training data. And based on the legal environment friendly to this testing data, and China has advantage on this part. So I'm going to gave an example to present how AI application changes our life and bring also huge opportunity of investment. So those are the 10 Chinese AI unicorn companies. And as you can see, 4 out of 10 are focused on the face identification. And this is exactly the application of computer vision. So not only that, computer vision has the other focus practice like object tracking, image segmentation, and also image imprinting. So China is already into the face scan payment, which is 4 months ago, Christian and I were talking about the QR code payments, but now it has been replacing by the face scan payment exactly based on the face recognizing technology. So the industry's most common used commercial level application is multi-target tracking, which identifies and tracks a variety of objects. Application areas like tracking suspected vehicles and traffic monitoring. Let's take a look of the scenarios. So the key point is the fast speed and the accurate tracking position for real-time location. Image segmentation distinguishes the target image from the surrounding image and separate them, such as recognizing the motions of human behavior, which can be used for spurs or criminal behavior recognition. And in the medical services, the tumor segmentation based on the medical image in order to distinguish the tumor from the organs. So maybe you have already known China has a system called the Sky Eye system, which is 176 million video camera on the streets that's collecting data, and exactly based on the data, the Chinese image identification is kind of at the moment advanced in the world. We're not only using the face recognition on the payments, we use it also on the pig farming, which is Alibaba invested in the pig farming and based on this technology, quite interesting. So let's take a look of the image imprinting. We were just talking about digital arts, and that perhaps is exactly the next generation of that how artist is going to create. The main technology is based on the generative anti-neutral network, giving a blank image and letting it learn another image with landscape, missions, or other objects. The part is completed will be naturally combined with the original part without any sense of continuity. But it's not original picture of original lost part, which is equivalently to AI help us to create a new part, mainly used in the creative industries. So the next slide I would like to introduce the smart manufacturing, because the smart manufacturing got supported by the national policy. And this national policy supporting has boosted the industry dramatically. So the smart manufacturing is currently in the growth stage. There are 3 aspects. The first, the improvement of digital capabilities of Chinese industry enterprise. And the second, in terms of financial benefit, the contribution rate of smart manufacturing to the company's profit has increased. The third is the term of typical applications. China has become the largest consumer of industrial robots with a strong demand. So let's take a look at the national policy to support the industry. By 2025, the smart manufacturing support system will basically established, and the key industries will be initially achieve smart transformations, which means that we'll be giving many industry opportunities, such as 3D printing, smart equipment, and that is, the Swiss company SBB really did a great job. And communication tax, industrial internet, the output value is 151 billion yuan, is a RMB Chinese currency, with a growth rate of 22.6% in 2017. And in 2018, this output value increases for 11.3 growth. So the next part I would like to say about 5G. And recently we all learned the news about the Huawei's. There were many rumors, news, and whatsoever related around this company. But we will have to see the 5G changes our lives and also brings many new industries and also opportunities of investment. Do I still have time? So let's take a look how the 5G changes our lives. Internet of everything. Imagine that everything can be turned to a terminal in your home. It's already starting, many type of AI hubs. And media communication and everything can be resigned in the cloud, efficient data, and smart network. This kind of scenarios will be, in 5 years, very soon to appear into our life. So the opportunities and application scenarios, education, smart medical, interconnection of vehicles, and the industrial internet. And the next 3 industries, I will say that's health tech and services, tourism and culture. Those are also in the growing phase in China. So my last page, I would like to put on figures, which is I always be asked by many people, what is the difference between China and India? We have a lot of similarity, but we have also significant features in China. We are the unified, big market. We always make a joke, which is especially for consumptions, which is no matter what kind of things you're going to sell in China, you're going to have 300 million consumers. And you are going to have another 3 million of consumers doesn't know your product, but it will be your potential customer. And second is technological innovation, which is I just explained. But there's also a point I would like to say. This is the large application market brings a secondary innovation in technology. And the high quality labor that it's already, because China nowadays, the IP application of filling out is already more than US. International influence, stability, and continuity of the China national development strategy and policy is well known in the world. We have every year 5 plans, so this is ensured the investment directions in a stable level. Thank you.
Thank you. And I think it's, thank you.
Thank you.
You can stay on stage. It's also interesting to see how the political system helps, because with all the things we can blame the Chinese political system for, one very big advantage is once the political system has decided to invest into all these new technologies, it is happening. Once they've decided to do more for the environment, the whole country goes there, and the investment goes there. And it's absolutely amazing to see the number of startup companies in high tech, the number of ideas that are coming from China in that area there. So it's really, even I would say, at the beginning of an exponential growth in terms of ideas and number of businesses that are there. Yeah, great. Thank you.
Thank you.
Thank you. The continuing on these investments and those portfolio, I would like to ask Manuel Salvisberg to come on stage. And we've presented Manuel earlier on as an artist and related to the art collection of your uncle and China, and investing in Chinese art. But you also have another hat, which is supervising all the investment for the family office. And with that, you have investment both in Asia and in Europe, and you have a great way of comparing also the two regions that are there. So I don't know where you want to be.
If you have a microphone, I prefer to standing there.
Okay, absolutely. So.
Thank you. How can I move the slides?
Through this. I think it should work. Yes.
Oh, excellent. Good. So thank you all very much for still being open-minded and giving me the opportunity to present what we do. Yes, I'm a part-time artist. I'm a part-time art collector. But mainly I manage the family office of Dr. Uli Sick, who also happens to be my uncle. So it's my family's family office. And our special focus is on direct investments in growth companies and technology companies. And we do that primarily in 2 geographies. One is German-speaking Europe, and the other is China. But quickly about the 2 key people with what we do. So Uli Sick, he was actually the first Westerner to do business in China once China opened up in '79. So for Schindler Elevators and Escalators, he negotiated the first joint venture to actually set up a factory in China that was with the Chinese government. And that later became the role model for basically almost all multinationals, Western multinationals that came to do business in China in the 80s and 90s. After this joint venture, he was quite actively involved in Schindler Asia. Later was asked by the Swiss government if he was interested to become the Swiss ambassador to China, which we felt was interesting because it was the time of the WTO negotiations, and China in the 90s was just very dynamic and still a lot to be done. He also was the largest collector of contemporary Chinese art until he donated his art collection to Hong Kong. He's still an active collector, so he now has the 2nd largest collection of contemporary Chinese art, which he may donate, I don't know. He sits on numerous boards of international institutions and companies, including the China Development Bank, which is the policy arm of the Chinese government. Also, he's the vice chairman of Ringier Media, which is better known in Switzerland. He's also at the advisory board of MoMA and the Tate, so he's also involved in the art scene. He's a long-term investor. He built several multinational companies, some of which have been quite successful, which also gave the foundation for our family office, which I personally, will talk about myself a little, have set up together with him 11 years ago. So since 11 years, I've been running Uli's office. I have studied and lived in Switzerland and Shanghai. I then went to work for BCG. I was in strategy consulting for a while. Then lived in Beijing, Shanghai, Hong Kong. Now I'm between Dubai and Switzerland and Asia. Out of my family office activities, I'm also the chairman of IALTIS, which is a fund of funds in hedge funds. We manage around $600 million US. I'm the chairman of a lubricants company called Batan. I'm the chairman of a company that runs training apps in China for the hospitality industry called Boost. And I'm also chairing Treksoft Group, which is a software company in the tourism activity space, mainly in Europe. So that's basically what keeps me busy. And well, as said, we've spent a lot of time in China. I'm going to talk about that a little bit. Just a little overview of our activities over the last 10 years, including what Uli did at Schindler's. That was in the 80s. Then we invested in financial services. So China Equity is a mid-sized venture capital and private equity player. It was one of the first in Beijing. We were an early investor there, became a strong partner of ours, and with them we did a lot of investments in the education space, in the internet space, among which we were early investors in Baidu, Sohu. We did some infrastructure investments as well. We bought about 30 hydropower plants, which is a bit odd, but it's quite interesting from a governance perspective and cultural perspective. We did stuff in the entertainment space, etc. About 15 more investments from online businesses to organic farming to fiber optic networks. We developed a few shopping malls. We owned and operated a boutique hotel, which I strongly recommend you not to do. But I just want to be a bit more anecdotal here. Sorry for not being very structured, and sorry for having lost my skill of creating nice slides. So what you need to do if you decide to go into direct investments in China? Well, very obviously, and probably same as anywhere where you would want to go and do direct investments, you need to build a network. And I think that's even more important in Asia, I think particularly in China. You need to know a bunch of people. You need to know the investors, you need to know entrepreneurs, you need to know some people that know people in the party, you need to know some people that are close to government, so you know what's going on. And you can't do that out of the Four Seasons in Hong Kong. It's a pleasant place, but it's not the right place. You have to be in Beijing, you have to be in Shanghai, you have to be in Shenzhen, you have to be in Guangzhou, you have to be anywhere else but in Hong Kong, because the real stuff just happens in mainland China. In order to create a deal flow, you need to have your network, because the deal flow comes out of that network. You have 1 million dinners and lunches and coffees and teas, and that's how you have an ear on the ground to see what's actually out there. So once you've done that, you may have teamed up with 1 or 2 other families or entrepreneurs or funds that you may have invested in and become a co-investor in direct opportunities, and then you get to see opportunities that you can look at directly. The next step is, obviously, if you've decided an opportunity seems interesting enough to go a bit deeper, is to negotiate. And negotiation is very different if you speak to a Chinese entrepreneur that has never been outside of China. The example, hydropower stations in southwest China. Or if you deal with a returnee, a so-called sea turtle, American-educated Chinese, MBA, coming back, very westernized, and that's much easier. So you very much have to adapt to the background of the person you're dealing with. So once you've negotiated, negotiation is obviously different than in the West if it's more Chinese, then you have to run your due diligence. And due diligence is extremely important, it's much more important than it is in the West. Because in China, there's a lot of hidden stuff. And there's a lot of stuff that we as Westerners do not understand, not only from a language perspective, but from a cultural perspective, from a legal perspective, and from a systemic perspective. Give you one example, the boutique hotel, my favorite. When we sold it eventually, the new buyer figured out that the entity, which was a government-owned company that was the owner of the land, was actually not the owner of the land. So it's pretty tricky to sell a hotel when somebody rents the space to you that doesn't own it. So this is just one of many things that we have encountered in China. Happens every now and then. You have to have a team in place that is very vetted in terms of legal due diligence, accounting due diligence, and also commercial due diligence, because it's tricky. I have created an extra slide for the risks, because I think it's full with risks. And I will go through them just one by one. So China, yes, it's humongous. It's 1.3 billion people, but the commercial pressure is tremendous, because there's just so many competitors out there. Everybody in China who's somewhat smart wants to be an entrepreneur. That just creates so many companies and competitors out there that whenever you have a good company, another one will come and copy what you do, which is a good thing. In the cultural perspective, it's smart to copy. You learn from a master and become a master yourself at some point in time. But it means that your business has to reinvent over and over again, because otherwise you get squeezed. It is extremely competitive, and it's much faster than anywhere in Europe or in Northern America. You have a counterparty risk. We've had, over the last 10 years, at least 5 fraud cases. In Europe, I've had 0. It's not a representative sample, but it just shows you the trend. We've had entrepreneurs that we felt very close with that all of a sudden disappeared, or that have changed their business scope, or just felt that it was opportune to do something else. And maybe not even in a mean way. I'll give you one example. We invested in a tech company to look at it a few months later, and it turned into a real estate business. And we said, look, man, that's not what we were in for. And then the entrepreneur said, yeah, but I just had such a great opportunity to buy that piece of land. So yeah, very opportunistic, and it's good as entrepreneurial spirit, but it's not the type of governance that we're used to. But that's just, what I also wanted to say with you have to be there, and you have to be very close to the entrepreneurs. Also, we've had issues where had a chairman of 2 companies, was cross-subsidizing, was being very flexible. So there's all these things that I'm not so much used to in Europe, but in China it's just a bit more flexibility with that. And you have to live with it. It's part of the system, it's part of the culture, and there's also upside to it, but there's downside to it too. Then the investor competition, as Claudia pointed out earlier rightly, there's tons of money. China hasn't waited for us. There is a lot of money out there. There's a lot of Western funds. There's a lot of domestic funds. There's a lot of government-backed funds. There's a lot of government-backed banks that will just pour money into industries that they deem relevant. So therefore, investor competition puts upward pressure on pricing. So you will end up buying expensive companies, and that is typically difficult to recover in IRRs, especially when the exits are not so easy, to which I'll come to a little later. Personnel is a big issue. Yes, there's a humongous talent. You have great universities. People are very, very skilled. In the big cities, you will find very skilled people, but they are sought after by the big corporates. Be that Tencent or Alibaba or Ping An Insurance, etc. They want the brightest people as well. So the hiring is expensive, and people are not very loyal. If their options are out of the money, they'll go somewhere where their option is in the money. So it's very much cash-driven. Also, if you're successful but you don't nurture your management well, they will go and found their own company and try to do what you're doing. Legal and regulatory is, to me, pretty similar thing. The regulatory environment in China is quite dynamic. I've seen it several times that rules change. I've seen it several times that we were told by the local authorities that we had to move a plant because they had different plans for that site, or because there was a new environmental regulation, or because there was a reason that we never understood. So there are certain implications that are very hard. Also, you need to license almost everything that you want to do. Give you an example for the shopping malls that we created. We actually didn't build the malls. We just organized the land and all the licenses to be able to operate these, and then sold that package to Carrefour and Tesco and all of these guys, because for them it was too cumbersome to deal with the authorities to get that package together. It involved about 15 different licenses just to be able to build and operate such a mall. And that equally counts for many other businesses, not only for shopping malls. So the regulatory is quite difficult, and is also difficult with regards to financial transactions, because, as you all know, China still has an onshore and an offshore renminbi market. And in the onshore market, that's basically where you need to go through SAFE, which is the state agency for foreign exchange, to get money in, but also get money out. And I promise you, it's very easy to get money in, but it's very hard to get money out. So again, we had examples where we needed to very quickly put money into growth companies because they need a lot of oxygen. Sometimes they run out of cash. So we went to the SAFE and said, look, this company needs money quickly. Okay, do the applications, go through the process. It took about 6 weeks to get the money in. Money came right back. I said, what's going on? He said, yeah, the amount you've sent over was $30 less than what you had applied for. And that was the bank charge. So we had to go through the whole process again, which would have killed the company. So we had to go through informal ways to get the money in, which leaves traces and which is not so nice because you have to clean up the mess later. So very quickly, these things get a bit haphazard, and you have to improvise a lot, and you just have to live with that. The last risk is the exits. If you buy expensive, you also want to sell expensive. Well, actually, you don't want to buy expensive, but you ended up buying expensive, so you just got to get your return. The stock market has been very bad in China. The IPO backlog is huge. There's hundreds of companies that want to file but never get there. and it's hard to sell these assets abroad. So therefore, you know, also all these backdoor listings and stuff that happened before Muddy Waters, forget it. So it's very hard to get out. So very often you have to sell to Chinese counterparties, and it's not that you have many alternatives to go to. So therefore, you have to ask yourself, you know, in the end, will your performance that you will get out of these investments compensate for all these risks and for this illiquidity? I think that's something you have to really weigh out very carefully. So just going back as a summary for what I've said just now, just be realistic what can be achieved. Yes, it's a humongous market. It's a great opportunity because it's growing, but it is hyper-competitive and it has all its challenges. So if you do it, then do it right. Commit resources, make a 10-year plan, put people in place, be in mainland China, find strong partners to do it with, and then it can work. Otherwise, just rather let it be, or try to find funds if you really want to be exposed in China. But doing directs in China is not a hobby, it's a full-time job. Thank you.
Thank you. Just how big is your team in China?
Our team in China is 3 people, so we have 1 investment professional and 2 admin, and then there's me who does both geographies, but we have very strong partners. So for instance, with China Equity, I have a team of about 30 investment professionals that we work with, and we have a few other entrepreneurs that we like to co-invest also.
Okay, thank you. So you need to have quite a lot of resources and a great network in place. So thank you. Martin. Again, we saw Martin this morning, Martin Hemming, who is an adjunct professor at CETIM in the Netherlands and who spoke quite profusely about venture capital and venture funds. But what you're going to talk about just now is not the venture capital and the venture funds. Another facet of what you do is to be an angel investor in emerging markets, in startups in emerging markets.
Exactly.
So you're going to talk more specifically on your investments, your direct investments into startups in China, and also tell us more on how to invest in China. Thank you.
Sure. What I want to show you, this is something I developed some time ago for you to understand. I looked at emerging markets year over year over year and how the startup arena evolves in emerging markets. And it was very stunning in a sense that they normally start in late stage in service businesses in most emerging markets, leveraging existing business models they have seen in the Western world, but often starting off with returnees to come back, financed very often by foreign VCs operating or maybe co-investing with local guys, but that's typical, and it's low tech in late stage. And then you have a few local VCs, you have the foreign VCs, I call it fly in, fly out. You have, as I said, the returnees, the government subsidizing, setting up, you know, sort of certain hubs or ecosystems, clusters. That's in phase 1 in emerging markets. Very typical services, retail, B2C, and so on and so forth. As we go into the next phase is, as the market starts maturing, and this is true for every market, the only thing I cannot control is the speed of it. China was ultra fast, so I've been 16, 17 years now in China, and by the way, your uncle trained me in my last corporate jobs. I had 20 years in corporate life, and 20 years now on startups and investing around the world. And I was trained how to go to China as your uncle was with Seco at that time, trained me 20 plus years ago. So the corporate VCs are coming in, and it's typically driven by foreign corporates, the Intels of the world, the Microsoft of the world. That's very common the case. It was true in every other emerging market. And they bring in some late-stage tech deals. And this is where the corporates are good at. And so they team up with some earlier stage VCs, whatever early stage means. It's a very different connotation in an emerging market. Early stage in every emerging market means early revenues. It's no joke, it is. But over time, as they then over years start going pre-revenue, that for many of them, being in China, being in India, being in Vietnam, and I've just come from all these markets the last few months again. And so what happens is that foreign LPs are also about to come in at that time. So that is typically around that time, driven also by the first entrepreneurs that exit. And that's, to me, that's always critical. So a few things that happen and drive in emerging markets is, as soon as, we call it the dirty dozen at Stanford, as soon as about 5, 10 larger exits happen, and those entrepreneurs then turn investors. And I'm coming back in detail how I have experienced this for the last 15, or actually it's not even 15 years, 8 years in China. That is a very critical element. So the first entrepreneurs turning investors. And then in phase 3, I call it, it's more maturing. And in a more mature market, then you have already had early, remember phase 1, going from late stage service into early stage. And then in the third phase is, second phase was late stage tech. And in the third phase, late stage tech turns early stage tech. And that's where China is very, very clearly today. And I'm not going to repeat what has been said there. So M&A plays happen on in, outbound, and so on and so forth. A lot more activities, and particularly the local guys coming in. The local corporates are being trained. I've trained hundreds of local corporate investment managers in Asia alone the last few years. And the local VCs are popping up, and everybody is becoming a VC almost in that sense. So where does angel investment then kicks in? And I'll come to this, and I'll make a comparison to China and India, and I'll give you a bit of feedback on my experiences and also what it means to investing there. Investment reference starts, so the preference in Asia is invest today, cash in yesterday. Right? Or invest today and cash in yesterday. I mean, it drives me bananas because if I invest, I'm a hardcore deep tech investor, and I normally write the first check. And this happened to be, because I'm at all these universities in those countries, half of them previous students of mine turning entrepreneurs, or second-time entrepreneurs when they come to me then. And here is how I have seen, I wanted to do a study in 2012 on angel investment in China. And I was trying to do this for the World Economic Forum through Stanford, and it was just the first group formed in 2012. It really stunned me. It was relatively late. I thought there were more angels around. Entrepreneurs turned angel, and then what I found that particularly true in China. I call it pooling entrepreneurs. So you look at the first wave of big-time entrepreneurs that were Western venture-backed and exited on NASDAQ or New York Stock Exchange. Some of them, the initial phase was a bit in service, and then the first tech guys came in. And what happens is that once they IPO, they're sitting on a load of cash too. They may still be busy running the business, but the ones who sell their company and get acquired. So I have seen entrepreneurs pooling in China, and I see this now emerging now in India, is the ones who are in service business, they team up, and they only do service type business. That's the business they understand. Up to the point where they can pull in up to, on 2-3 rounds, up to 100 million, not even needing a local VC. That was stunning me, right? And you have seen a few deals, particularly in the last 3-4 years in China. Now, when they grow them super unicorns, where they need a lot more money, they still bring in the institutional investors then, or the corporate investors. And same thing on tech. I have experienced tech entrepreneurs in China, and all they do is team up as a pool of 5, 6, 7, 8. Some of them still running the business, and the ones who sold the business just do actually those investments. And they know what they're talking about because they have done 1, 2, 3. One of my friends, a Chinese friend, has done 6 companies, 2 public, and 4 in the last 16 years in Beijing. VCs then, what happened also is VCs set up seed angel funds. I remember that time. It was very often when it was foreign capital, it was an offshore vehicle. And here's what happened. They could only invest, and I'm sure you remember that time, they could only invest with a dollar-denominated fund it was very hard to invest in a very early stage company. Why? Because it took about 6 months to convert a Chinese company to be ready for a dollar investment. And by that time, the deal was gone. And the Western LPs, and that included a lot of family offices, by the way, did not understand that extreme dynamic, and they were not willing to give the money even to successful VCs in China to do RMB to set up an RMB fund. The key is to get early into the best deals, and you need an RMB fund, especially a few years ago at that time, to do that. And so the VCs who made enough money pulled their own cash in to create an RMB fund because they wanted to get access to those companies early on, and when they got into those companies, they had enough time to see if it's going to be a winner. If it was becoming a winner into the next phase, the next stage of investment, they had 6 months' time easily to convert that into a dollar-denominated. So that's when the foreign VC, the dollar-denominated dollar fund, came in to do this. That's a little bit more. And then later on, it was the start of the corporate VCs that kicked in. And normally they start in very late stage. It's driven by foreign corporate VCs very often. Intel, the Microsofts of the Intel Capital was one of the very first ones actually in China, a long time ago. And so that was the corporate VCs, and then the rise of the domestic corporates. And you will see the Chinese have matured big time, doing massive investments. I do entire trainings. Now India, you will see Indian corporates setting in a lot more. India, as an example, very risk-averse, even more risk-averse to me than the Chinese, and I'm a deep tech investor. So 10 years ago, I had almost zero competition at that time. When I wanted to start investing in China in 2012, 13, it was already getting very late because the local guys were mature enough. Those returnees have made money, and the ones who exited. India was still a green playing field, and it's only starting to change. I may have a window for another 2-3 years, but what's happening is most of them made money in real estate, they made money in trade, and they're a lot more risk-averse than you would ever think of. And then they also asked, show me revenue first, show me traction. And that's an angel investor. I mean, that's when I need an angel investor to get to the point, but not in India. It's only starting to change about as of last year. The next thing is VCs and corporate VCs. For the first year, last year now, new funds being raised, 40% now are raising for tech, which was not the case at all a few years ago. Anyway, so in terms of family offices, I found something very interesting in India. I found it also in Korea and in Taiwan, in those 3 nations, is family offices. If it's the 3rd generation, very often the eldest son might still be running the family business, but that's the 2nd son or the 3rd son, they do venture investing. And what struck me, the very smart guys that I'm meeting out there, they're actually investing 1 out of 2 deals or 1 out of 3 deals to help support their existing assets, which very often is traditional industries, to upgrade into digitizing them nowadays. Because the parents and the older sons, they don't really get it, and they use that as a vehicle to digitize. I found this very enlightening, actually. So I'm skipping this, saying 2 examples of investing. And I give you the one called Carbon Clean Solutions. That's, again, I know in that case I was very extreme. They were still 22-year-old kids at the IIT in India. And I have met, I'm at both IITs, Delhi, Bombay, for years, for 15 years, same in China. And I found these guys presenting once to me, and I go like, I love what you do, but the strategy sucks, and this is not good. But 2 months later, they were the national champion of the Pan-IIT Business Plan competition, global business, across all IITs. 2 months later, I took them to the Valley, and just to bring them to the best experts at Stanford and at Berkeley, expose them to the Vino Korslas of the world, the John Doerrs of the world, that's no joke, by the way, and they told us how complicated this is. I said, I understand venture investment. This is carbon capture, CO2 capture at scale, at massive scale, from power stations, cement, refineries, steel, aluminum, and so on, you name it. Today, you will be stunned. every other competitor, and these are just 2 metrics I want to share with you. There were 5 competitors, 1 died. I talked the ones who do large scale, not small carbon capture, at scale. They were all in Canada and in US mainly at that point. US finance predominantly. They raise anywhere from 64 million to 162 million just to go commercial. This company is an example. We butter everything. We get everything negotiated. You will not believe. I do not bring in a venture capital investor until very late in the game. With 1,050,000, we were commercial at half the time of anybody else. Tested in the Netherlands for the EU at TNO, and tested at the DOE, Department of Energy, Alabama Test Center, and by a large margin, a lot better. The carbon capture cost, and took them to China, I took them to PetroChina, to you name it, to the cement, to all these guys. And the only way they were thinking is carbon capture sequestration. And it's very expensive. And I said, that is not a solution. That's not sustainable. Long story short, these guys are now being paid for the R&D by the DOE in the US to come down to $20 per ton captured. That's one. And the other one, I just want to adhere.
Maybe because we're running out of time.
30 seconds.
I think we can stop at this great example.
Okay.
It was wonderful. And let's have some more time also for questions. I'm sure the audience is burning.
All I'm saying,
questions.
last sentence, I take every of the startup global to where the market is. Clean tech more to Europe. Life sciences more if it's huge out there in the Boston for pharma, biotech, and cancer. And if it's IT, enterprise, it's definitely Silicon Valley. So that's the way, and you saw my data in the morning, startup that go international, scale and exit international, it's a massive premium, according to 5,500 exits. Okay, thanks.
Stay here. I would like to ask everyone on the panel to come back, and because I'm sure there are questions on investments and the things they do. We've seen different types of investments and different perspectives, geographic perspectives as well. And I have tons of questions for them, but I'd like to start with the room and to see if there are questions. Yes, absolutely. Right there at the back.
Thank you. Obviously, it's about Asia, so I'll limit myself to Asia. But why are we going to focus on Asia? Because obviously, US and Europe, that's where everybody is, and that's where everybody learned the private equity game. So, what is the motivation for an investor to go to Asia, other than the great stories that we're being told, and why not other parts of the world?
Diversification, chasing returns that may be fictitious, and not having enough risk on your book. If you don't want to add more risk to your portfolio, don't come to Asia.
And also, Claudia, this morning you also mentioned the demographics. And by 2050, 50%.
But that's a long game.
Yeah,
so,
it's a long game.
Again, most investors can't really have a hard time looking beyond 10 years. So, if 2050 is good enough for you, then by all means. I think, if you're saying we're running a global portfolio, you cannot not have Asia in it. Then you're not running a global portfolio. So you got to be very honest for you, but be where you actually can add value. As everyone here, I think, said, Asia is complicated. It's difficult. It requires boots on the ground. It takes the time, a learning curve. You're not going to basically get your, 15% IRR on day one. Forget about the 25% IRR. So it's the usual question, right? Risk versus return. The risks you're taking, do they justify the returns you're seeing? And when do you have to see those returns? It's a really good question, and you're right. Yeah, don't go there if you can't.
So demographically, it's growing fast. So is Africa. There will be a billion people in 20 years.
That's true, but Africa, for as long as I've been around, has always had potential and never delivered on it. Asia, at least, has occasionally delivered on it, right? So Africa has a complete different risk appetite, right?
Safer choice out of the emerging markets.
On a relative basis, it's a more mature market, yes. Is it safer? Define safe, right? Again, we have to talk about your risk appetite. I don't know what you perceive as safe.
If I may add to that, I fully agree with what you're saying. you add a lot of risk to your portfolio. But a lot of investors, they have also passion when they invest. They say, look, I want to be part of that story. I want to be exposed to it. I want to see it. And yes, there's lots of opportunities. And we've seen some cases really explode. But my general conclusion after 11 years of running parallel portfolios in Europe and in China, to be honest, after all the risk and the work, etc., I found the returns to be better in Europe.
I think one more element that I would like to add is depending on what you're investing in, just going back to the question on Africa, it will take another decade just to get the basic infrastructure layer properly done to deploy a lot of things that Asia has in the last 5, 6, 7, 8 years already absorbed and is absorbing as I'm speaking.
Yeah, but to be fair, there are great opportunities of investment in Africa as well. I mean, to keep a balance in there. Any other question from the audience? Yes.
Aiping, I had a question for you about investing in Chinese IT. I mean, isn't the flip side of the coin hacking? So how much of an issue is hacking into all the IT-related stuff you're saying? Because it's all IT, and so it can be hacked. So
you're talking about the security of the AI, or?
Yeah, all of it, data, broadly, yeah. I mean, because it's all hackable, right? So how do you sort of mitigate that risk in the ventures and whatever you're looking at?
By technological level, I don't really know that how the IT companies protect their data. But yesterday, Christian has asked me a very interesting question that, how do you think which is the AI application and with the privacy of the users? And my answer regarding to this topic is because the AI application is also changes our convenience and also our tolerance of the privacy protection. And you will see the tolerance of the privacy, the board could be getting wider. It is just the balance between convenience and also privacy protection. And of course, in Europe, this privacy protection is much strictly than in China. And this kind of a topic is already addressing discussion topic in China. But unlike in Europe, which is, even though we have questions, we are doubting about that, we are questioning it, and we have discussion on that, but the application goes much faster than we are thinking or we are doing. Yes, please.
Actually, there's one advantage with that. I'm invested in a lot of digital companies in Europe, and in China, data privacy is not a big issue. Also, the consumer just doesn't care, while we care a lot. And I've experienced that over and over again. So that gives these companies an advantage because they can build solutions on data that is just much more widely available than it is here. So therefore, for us to follow with these developments is very hard. So all with regards to AI, big data, etc., they have a much larger pool of data, and the consumer doesn't care. The consumer prefers the convenience. And also in a non-trust society, they're like, I'm happy if everybody's open book, because then I know if that person's a crook or not. So there's a different kind of thinking.
I had one more question broadly. I mean, in all the angel or the VC investing, what's the ratio of those that get successful to those that flop completely?
You mean in AI or what? Or in
just
general?
broadly.
Actually, so what I have found is, I'm taking China as an example. I can add on India and some other Asian countries. In the early days, and I go back 16, 17 years now to China, there have been a lot of copycat models at that time. And take Groupon was a great example, right? We all know, and Claudia will support that, there were data out anywhere from 3,000 to 6,000 copycats of Groupon in China alone. And needless to say, I mean, 90% need to fail and crash sooner or later. And so, however, this pure copycat is actually still partially happening, but there's a lot of very cool innovation happening actually in China. You'll be stunned how far they can go, particularly the two areas that she mentioned. So the failure rate today, when I look at it, and I was involved at the Ministry of Science and Technology and the 58 Science Park in China for 3 years on looking at financing models in China across to scale those investments. It is not that much higher as is. The difference is they're going to be killed much faster here. While a lot of Chinese entrepreneurs, I call it living, living dead, basically, walking dead around, kind of. They don't kill them off as quick because a lot of the early funding still comes from families, and they hang on much longer than institutional investors who would come in here in the Western world much in that sense. So. Now China is moving a lot more early stage in venture as well.
Martin, sorry, but I know that.
Just very quickly. So in venture, and to my knowledge, China is not beating that. And looking at data, 8 out of 10 investments will not return the money that you're investing.
No. Claudia, I know you have to go very soon, but can I have just one last question for you, because I think it's important. In Europe, at least, and North America, there's a big buzz and a growing interest into green funds and ethical funds. How is that in Asia?
It's not a concern in Asia.
At all? Okay.
So, I mean, there's some of the younger generations and family offices are interested in impact investing, but green, clean tech, anything around that, it's not relevant for us. Not yet. So there's some countries where, yes, I mean, Singapore is trying to drive that, but de facto, we have in Asia, by far, the countries that are the biggest polluters on the planet. Mm-hmm. So, and they're not willing to basically make any changes. So therefore, I mean, any fund that claims to do investment in that space is basically just putting lipstick on a pig. So. Okay. Sorry to say.
So it stays more at the businesses level and the individual investors
I wish it would, yes. So, but there we're going to have to see it first. Right now, it's not something, if you're trying to raise money in Asia from Asian investors on that premises, I'm pretty sure you won't find a lot of reception.
Okay, thank you. Thank you. See, I know you have to go.
I'm really sorry.
So, thank you. Thank you.
Thank you, Claudia.
The quick question to Amber. Amber, one of the topics that you mentioned as a high investment potential was tourism. And it is true that we've seen Chinese investors buying Club Med, Pierre & Voyage, there's a lot of investment from Chinese investors into tourism for Chinese people. It's a huge internal market. How much is that also a sector that is open for foreign investors?
During the recent changes, because the trade war between China and the USA, so some policies which is before forbidden to invest in China is going to open a door. So from my research, which is the tourism investment, it has to be cooperated with a Chinese tourism company. Otherwise, the foreign investors are forbidden to invest it directly into China. And this kind of a policy perhaps will be changed. What I heard from friends, which is, I mean, this is the news under table, it's not announced yet, but I heard which is the policy perhaps will be changed within a year. So let's see what is the result or what is the end of the trade war between China and the USA. Perhaps that will be changed.
Okay, thank you. We have time for one last question. Anyone has one last question in the audience? Yes. And then it's break time.
Yes, a quick question. You discussed a lot about China, some about India. What about Japan? What is going on in Japan in private equity, and what is missing for it to catch up? But because we know about SoftBank, but what else, basically?
Yes, so luckily, as I said, I used to live in Japan. I speak Japanese. I think if I look, I can only comment on venture. I cannot comment on the private equity. So for many years, as I said, I've also been at Tokyo University and Tokyo University and two others in Japan. And what I have found, and I did a lot of research also in Japan actually for the government there, benchmarking Japan against the rest. I think one of the challenges I have was the corporate venture capital investment in Japan is actually very high, over proportionally high to the rest of the world, with the exception of Thailand, okay? On the other hand, what it also means, and I give you my practical examples for, you see here 2 angels. I've done a lot more. I just want to give 2 cases. So some of the cases I will never, ever bring, with the exception of 2 or 3 companies like Rakuten. I mean, the new generation internet type of companies. I will not bring a startup for their first client to Japan, even if the market is ready for it. The reason is they're so risk averse. I mean, even more than the Indians. You cannot even imagine this. So it takes forever to get a deal done with a Japanese corporate in early stage. And the stigma is a lot worse still than it is here in Europe. I mean, Europe has dramatically improved. Japan is still way back. I mean, I've spent a lot of time in Japan trying to do investments in Japan, and as of today have not done a single deal in Japan. I will go back again this year. Some of my friends tell me it's changing, but you know, it needs a radical change. I'm not sure they are changing that rapidly and fast. But the talent and the technology they have is truly amazing. I'm looking at the top 3, 4 universities, what they crank out in terms of technology. It is just amazing. It's the adoption and then the risk-taking. So a lot of entrepreneurs I met in Japan, they're still partially employed. They don't let go their corporate job or do part-time. No joke. So I don't think it will happen, and I'm sure great technology will occur. Now, hopefully, the new wave, which is happening right now, finally will make it. So far, it has not made it.
Yeah. So sorry. Go ahead.
I would give also another 2 aspects to inspire you thinking. The one that's Japan really facing the problem of the reputation structures, which is young people getting less and less. I don't have the specific numbers right now, but if you take a look in the internet, you will find out these kind of figures, which is the young people are perhaps getting less and less every year. I think the reproduction rate is even lower than 1%. So in this case, and then if you look at the market, I mean, Japanese market is relatively much smaller than the Chinese market. So which an investor, if you look at the application market, China and Japan, and they will automatically to find a way to enter into China. But as the innovation of the technology, that is great in Japan. However, what I see, the most successful case is the innovation in Japan, but the application in China. Yeah. If you can combine this market, that would be very good.
And the problem is a catch-22 for entrepreneurs in Japan. Japan is a big enough market to stay local until you scale relatively large, and then to change the DNA of a corporate from a startup, in a mature startup, to go international. And then they always claim a language problem, whatever. You will not believe it. So it's a catch-22, the size that Japan has.
Okay, just as, because we now definitely need to go and have a break. Fantastic. As a conclusion, huge potential, quite a number of new ideas, new tech, moving very, very fast, lots of opportunities, huge risk as well. There's no other solution than to go there, experience, meet people, develop your network, and really feel what it is. It's very difficult to assess it from here. Thank you, everybody. Thank you.
Thank you. Amber, may I offer you?